This is a video about value traps brought to you by Polaris Investing.com, a website for creating defensible valuations. Start off with a little background on value traps. It's somewhat evident in this picture here of this mouse trap. A value trap is a stock that at first appears enticing, but upon further review is quickly realized is not nearly as valuable as it first seemed. This is often captured in the phrase cheap for a reason. As demonstrated in this picture, investors have a tendency to focus on past data, which often doesn't yet fully reflect a possible deteriorating outlook for the company. Price is typically significantly fallen recently by virtue of some kind of a surprise, like poorer than expected earnings reports, or some kind of a lawsuit, or possibly a key executive unexpectedly leaving the company. Typically, the market reacts emotionally in a very quick manner, kind of shoot first and aim later mentality. When an investor comes across a stock that has had a recent significant drop in price, really, if the investor chooses to invest, they're really hoping for essentially a recovery from whatever brought the stock down recently. Recent example of this is Johnson & Johnson. The baby powder product has had several lawsuits. Recent lawsuit had a verdict that went against Johnson & Johnson. The stock price immediately went down 15%, but within several months it came back up over 10%. Value trap stocks rarely recover this quickly, or at all. Rather, they are typically permanently disrupted. A value trap is also referred to as catching a falling knife, and the best way to catch a falling knife is to wait for it to hit the ground. Problem with stocks is you don't know when a price has hit bottom. Investors fall prey to value traps from just doing surface level analysis. They make assumptions and use historical data that doesn't fully reflect the current outlook. This is a form of speculation where you hope the company will simply return to its former performance level. Things that you should consider when valuing a stock, particularly a value trap, a potential value trap, is has there been recent bad news? Is this bad news dominating all news, even possibly masking some good news? Is the sector or industry that the stock is part of in a cyclical or secular decline? A cyclical decline is temporary and more likely a company will recover from. But a secular decline in the industry or sector is a long-term structural change that the company is less likely to recover from. At a minimum, will require the company to make drastic changes to its business model. And then think about yourself. Are you rushing into the purchase? Are you anchoring price based on past price instead of thinking about the future? And your analysis, are you being just overconfident in your analysis? Is it possible that you overlook something? Are you oversimplifying the situation? All right, so let's look at our real life example using the PolarisInvesting.com website. So we're going to use a company named Newell Brands. Newell Brands is a cyclical company that makes houseware goods. May have heard of some of their products: Elmer's Glue, Crazy Glue. They make pens that market under the name of Sharpie, Papermate, Parker, Rubbermaid storage containers, Coleman ice chests, playing cards like bicycle playing cards, Sunbeam appliances, Mr. Coffee maker, crock pot, as well as several other well-known products. So using the Polaris Investing website, you want to look at some objective values to get an idea of whether you're looking at a value trap or not. One is the sales forecast. Second one is the operations type. Third one is this price momentum. And then you want to look at some financial details, and then the debt to equity ratio. So to start off with the sales forecast, if you look at the theoretical valuation in the by default, the sales growth that Polaris has calculated for Newell Brands, you see an 18% sales growth. But if you look at the implied sales growth through the current market price and then working backwards to using the valuation formula, you come up with an implied sales growth in the current price of -4%. So right off the bat, when you see a difference in direction of sales growth, of the market thinks sales is declining, likely going to decline, but the theoretical valuation is using a value that assumes growth of sales. Need to look further into whether this may be a value trap. And on top of that, for Newell Brands, we see a significant, not just a difference in direction of the growth, but also fairly significant difference in opinion between the market of -4% and then the Polaris default value of 18%. And next you want to look at the operations type, and as a reminder, this tooltip comment here is that operations type is a categorization that Polaris does based on whether it's noticed something that reflects that the current operations are going to be, or future operations are going to be much different than current operations. This usually is things like negative earnings. If the most recent year is negative, then for the company to sustain and be in business long term, it's going to have to eventually turn a profit, and therefore change its operations to be to be profitable. Another thing is financial structure, which includes debt and outstanding shares from the potential exercise of stock options. Also, R&D expenses, and then last one is whether analysts follow the company or not. But having looked deeper before this video was shot into what's driving Newell to be considered dynamic, is this its most recent annual financial reports showed negative earnings per share. Now, for dynamic companies, Polaris, when it calculates the default sales growth, will not base it on analyst forecasts, but rather it'll look at the most recent sales trends, because that's really the only thing that available data. You just go with what's available. And it assumes that the recent sales trend is indicative of the start of some change. It's some inflection point where you're starting to see it in the most recent sales data. And then from there, sales is extrapolated out. Now, this is kind of odd because I said earlier that dynamic operations are considered, the future operations will be significantly different than current operations. But the reason that recent sales trend is used to get an idea of where future sales could be going is, again, it's assumed that we're right at this inflection point. We're starting to see in the most recent sales data an indication of this inflection point. But for value traps where the outlook is deteriorating, it's more likely that is now fully reflected in the current sales trend. That the deterioration is so recent that making an assumption that the last couple of years we're starting to see this inflection point is just wrong. And so that's what we're definitely seeing with Newell's, is looking at some recent good sales growth, and it's not incorporating into it the recent news that will likely end up driving sales in a much different direction than what we've seen over the preceding couple of years. So when you see an operation type of dynamic, along with what we just went over previously about the sales growth 18% versus minus 4%. Well, those two together are pointing likely to this 18% growth. Is this based on irrelevant historical data? Now, to go further, if you look at the price momentum, you notice that there's compared to the relative overall market, the price has come down substantially in the last 3 months. So that yet is another indicator that you're likely looking at a value trap, and that the sales growth of a theoretical sales growth of 18% is just based on data that's just no longer reflective of the future. But to shed more light on what's going on with prices, it's worthwhile to come down here to the bottom and go out to Yahoo, and let's look at the interactive chart over the last year for Newell. And we'll see, and then also showing the S&P 500 index here in the lighter blue line. And what we see is a kind of a classic example of a value trap, where just going back a year or so ago, you see that Newell's staying in line with the overall market, but then all of a sudden there's been a fairly significant drop, and then we see that the market kind of thinking that it's been overdone and drives the price back up, only for the next quarter earnings report to likely have been the news that broke that drove the stock down quickly. Some denial in the market, optimists thinking that it's been overdone, only to see it drop again. And then we see it go up, and then an earnings report drops it down again. Then here's the most recent earnings report, saw the Newell drop 20% in a day. So a lot of denial going on in the marketplace, and it takes some news to reorientate the market in terms of its pricing. And then so it's definitely something that the data bears out that it's likely a value trap. So to get an idea of what is behind these sudden drops that we've seen over the last couple of quarters, it's worthwhile to go out to take a look at the financials. And to do that, I'm going to go out to the CNN site, and then you can see here that sales have gone up significantly over the last 3 to 4 years, but here in the most recent year have had quite a drop. Now that big of a drop from 14.7 billion to 8.6 billion may even reflect some spin-off or selling part of the company, or it could be something where the businesses have just deteriorated that significantly. Now, if we go down to the bottom and look at earnings per share, we can the same thing and see it going up, earnings per share, and then having a big drop here in the most recent year. So this financial data kind of reinforces yet again that we're looking at a value trap here. One other thing to look at is down here at the bottom of the Polaris or the ticker page on the Polaris site is the what's going on with debt. And if you see anything above 2, it reflects a debt to equity ratio that's considered to be unhealthy. But you see here for Newell Brands, 1.1 is a reasonable debt to equity ratio. So that's not indicating any real leverage issues. All right, so looking at the some objective indicators here off the Polaris website, it's clear that this is a value trap, and the sales growth of 18% just is not reflective of the deteriorating outlook, and that the market probably with its minus 4% growth assessment is probably more realistic of what you can expect going forward. But there are some other subjective things you should consider as well. One of those is, has management been over-promising and under-delivering in terms of their outlooks? And the way to get an assessment of that is to go out to a site like Estimize and just look at how many earnings surprises has there been over the last couple of quarters. The other thing to look for is whether activist investors have gotten involved. If not, that's kind of a clear sign that activists do not consider this to be a good turnaround opportunity. Also, you want to look at the company's strategic competitive advantage, often referred to as the moat. Has it been compromised? Are they ceding ground to new competitors? As mentioned earlier, consider whether the company is in an industry or sector that is experiencing secular decline. Examples, old economy sectors like retail and financials. They're cheap not for short-term cyclical reasons, but for long-term secular ones. Is the strategy itself kind of fuzzy? Example of this is Hanesbrands several years ago had a sudden drop in price as a result of our earnings report, and it dropped 20%. And then on the earnings call, management didn't seem to really have a firm understanding of their problems. They somewhat seem to be in denial, and this is a reflection of management just stuck in their old ways. So you want to look at is the board of directors, is it longtime members? Are they just kind of feeling like this is same old, and they're just going to wait this out like they've waited other past problems out? Another thing you want to look at is opaque accounting. Heavy use of proforma metrics like user counts and just things that are not really GAAP financial metrics. And this could be an attempt by management to just cover up poor financial performance. Another thing to look at is stakeholders maybe stalling the recovery. Example would be maybe unions positioning for higher wages and doing some kind of work slowdown that's hitting the sales, the bottom line, and also the top line sales growth. So when you've come across a value trap like Newell Brands, what's the best course of action going forward? Well, first, the most important thing is to slow down. Take your time in doing deeper analysis, and obviously do not be in a rush. It could be weeks, months before you feel comfortable you really understand what's driving such a different outlook compared to what the company's been performing at in the recent years. If you do decide to move forward and you feel like it is recoverable bad news, you should use a put option to limit your downside as you initially take a position in the company. This put becomes an insurance policy against anything that you may have overlooked in your analysis. And when you do buy in initially, you should only invest 30 to 40% of the total amount that you eventually plan on putting into the stock. You should wait for a 10 to 15% change in price, either up or down. And then once the stock moves, decide whether you want to continue to invest more. If you decide you want to continue, then invest another 20% and wait for another 10 to 15% move before buying any more. And then, above all, you should make sure that you continue to have a good margin of safety built into your valuation. So if let's say here I decide to move forward with Newell Brands, well, I'm not going to go forward with 18%, but I do some analysis and I decide that the market's maybe overdone a little bit. I think maybe they can at least recover and earn a 4% sales growth, and that still would be a very attractive return of almost 16% theoretical and 13% or 12.9% practical. So in closing, remember that most companies that you consider for investment, let alone value traps, are not going to be worthwhile investments. You should be skeptical of the data and always be on the lookout for how things could go badly. So this has been a video on value traps. Thanks for watching.